There's a version of you that sits down at the platform every morning with a clear head, a solid plan, patience for the right setup, and executes accordingly. And then there's the version of you who gets anxious when a position moves against you. The one who hesitates on a clean entry because the last trade still stings. The one who sizes up when things are going well and tells himself it's confidence, not recklessness. The one who closes a trade early because the uncertainty feels unbearable, even when the setup hasn't changed. Every trader knows both versions of themselves, and the gap between them, that gap is where most of the money gets lost. Today, we're talking about emotional trading. Not in the vague, generic way you've heard it talked about before. We're going into what it actually is, what it actually costs, and, most importantly, the shift in thinking that separates traders who eventually make it from the ones who stay stuck in the cycle forever. Let's start with a definition, because emotional trading gets thrown around so much it's almost lost its meaning. Emotional trading isn't just trading when you're angry or scared, it's subtler than that. Emotional trading is any decision you make in the market to satisfy a feeling rather than to execute a probability. Read that again. To satisfy a feeling, not to execute a probability. When you're trading emotionally, you are not thinking about logic. You are not thinking about your edge, your risk-reward, or what the setup says. You are thinking about what you feel like doing. What will relieve the discomfort you're experiencing right now, in the moment? And that's the key phrase, right now, in the moment. Because the emotional response is always optimizing for the short term. It wants to fix how you feel today. It has no interest in your account balance next month, or your win rate over the next 100 trades, or the trader you're trying to become. Feeding an emotional urge in the market, chasing a move because of FOMO, holding a loser because you can't face the loss, sizing up because you need to feel like you're making back what you lost, will comfort that feeling. For maybe 60 seconds, and then reality arrives. And reality in the market has a way of being expensive. The logical mind, the probabilistic mind, the one that built your system, that understands your edge, that knows this is a game of hundreds of trades, not one, that mind leads to trading success. Not immediately, not every day, but over time, if done consistently, will lead you to your trading success. The emotional mind almost always gives you the wrong answer. Not because you're weak, but because it was never designed to trade. It was designed to survive. And surviving and trading profitably require completely different responses to the same situations. Here's something that sounds obvious when you say it out loud, but that almost no one actually trades like they believe it. The market does not know you are there. It doesn't know you're feeling anxious. It doesn't know you had a bad week. It doesn't know that your stop loss is sitting at a level that, if hit, will wipe out your gains. It doesn't know your strategy, your bias, your conviction, or your account size. It doesn't care that you did everything right and got stopped out anyway. It doesn't care about you at all. The market is not a person. It has no awareness of your emotional state and no obligation to respect it. It is simply the aggregate of millions of participants, each with their own positions and their own agendas. And the net result of all of that moves price. That's it. That's the whole thing. So when you make a decision based on how you feel, when you widen your stop because you can't emotionally accept being wrong, when you move your take profit because you're greedy, when you enter a trade because sitting on the sidelines feels unbearable, you are introducing a variable into your trading that the market will never validate, account for, or reward. Emotion is not a market variable. Price doesn't move because you're frustrated. A level doesn't hold because you need it to. A reversal doesn't come because you've held through enough pain to deserve it. What the market does respond to, the only thing it responds to, is the behavioural pattern of participants over time. Patterns that have played out before, and play out again because human behavior at key levels is consistent. That's your edge. Pattern recognition executed with discipline across a large enough sample of trades. What is not included in that edge, what cannot be part of a real trading system, is emotional decision-making. Because emotional decisions are unpredictable. They're different every session depending on how you slept, what happened in the last trade, whether you're up or down on the week. You cannot build a probability-based business on inputs that change with your mood. The market will do what it does. The only question is whether your decisions are based on logic or on a feeling that has no idea what a support level is. Now here's where I want to go somewhere that most trading content doesn't go, because I think it's the most important thing to understand if you actually want to change the pattern. Most of the time, the reason you're trading emotionally isn't because you lack discipline. It isn't because you don't know the rules. It's because you haven't fully accepted the risk of the trade you're in. Think about that for a moment. You're sitting in a position, watching it move against you, feeling your chest tighten, watching your hand move toward the mouse or phone to close it out early. What's actually happening there? What are you protecting yourself from? You're protecting yourself from a loss you haven't accepted yet. Somewhere in the back of your mind, you entered that trade believing, really believing, that it was going to work. Not as a probability, as a certainty. And so when price moves against you, everything that follows is emotional self-protection. You adjust your stop. You close early. You refuse to enter the next clean setup because the last one hurts. You are doing whatever it takes to avoid experiencing a loss you were never fully prepared to accept. Now compare that to what happens when you genuinely accept the risk before you enter. When you look at the trade, define your stop, and truly, not theoretically but genuinely, accept that this money is already spent. That the worst case has already been priced into your decision. That if the stop gets hit, it's not a failure, it's not a betrayal. It's just the cost of participating in this trade at this moment with this probability. When you reach that level of acceptance, something changes. Not in the market, in you. There is nothing left to protect. The loss is already accounted for. So when price moves against you, you don't panic. Because the outcome you feared has already been accepted. When it moves in your favor, you don't get greedy. Because you already defined where you're getting out. You just sit there, calm, and let the trade play out the way you designed it to. That is what trading without emotion looks like. Not the absence of feelings. You'll still feel things, especially during the trade. But feelings that don't get to make decisions, because you already made all the decisions before the trade started. The emotional trader is constantly managing an outcome they were never ready for. The disciplined trader has already lived the worst case in their mind and moved on. Let's talk numbers for a minute, because emotional trading isn't just a mindset problem. It has a very specific, very quantifiable cost that most traders never add up because the losses are spread across dozens of sessions, each one looking like bad luck rather than a pattern. Here's how the bleed works. You have a system, it has an edge. Over 100 trades, your system wins 55% of the time with a 1-to-1 risk-reward. On paper, that compounds beautifully. It's a real, profitable edge. But then, emotion enters. You close winning trades early because you're scared of giving back profit, so your average winner shrinks. You hold losing trades too long because you can't accept being wrong, so your average loser grows. You skip setups after losing sessions because you're gun-shy, so your sample size drops and your edge gets diluted. You size up after wins and down after losses based on how you feel, so your position sizing becomes random instead of systematic. None of those individual decisions feel catastrophic in the moment. Each one has a justification that sounds reasonable. But run them across 100 trades, and that 55% winning system starts producing the results of a 45% losing system. Not because the edge disappeared, because emotion eroded it from the inside. This is what makes emotional trading the silent account killer. Revenge trading is loud. You know when it's happening, even if you can't stop it. Overtrading has a paper trail. You can look back and count the trades. But emotional trading is quiet. It hides inside decisions that feel like they might even be good ideas. It disguises itself as prudence, as flexibility, as reading the market. By the time most traders recognize the pattern, it's been running for months. And the cost isn't one bad session. It's the cumulative erosion of an edge that was actually working, destroyed not by the market, but by the trader's own emotional responses to it. So how do you actually make the shift? How do you move from a trader who makes decisions based on feelings to one who makes decisions based on probabilities? It starts with reframing what a trade actually is. A trade is not a bet on a specific outcome. A trade is one data point in a large series of probabilities. Your edge doesn't live in any single trade. It lives in the behavior of your system across hundreds of trades. Any individual trade can go either way. A perfect setup can fail. A marginal setup can run. That's not bad luck or good luck. That's the nature of probabilistic systems. When you truly internalize that, the emotional weight of any single trade drops dramatically. A loss on a good setup is not a betrayal. It's one of the losing trades your system already expected to have. A win on a mediocre entry is not confirmation that your instincts are sharp. It's the random variance your system also expected. Neither outcome means anything on its own. What means something is 100 trades from now. The practical application of this is pre-trade acceptance. Before you enter any position, go through 3 things explicitly. Not in your head, in your journal, or out loud if you have to. 1. Define your risk. The exact dollar and percentage amount you are risking on this trade. Not a vague sense of your stop. The number. $80, 1%. Whatever it is, be clear on it. 2. Accept that risk. View that number as already spent. Not, I hope I don't lose this. Not, the setup is good so I probably won't lose. The money is spent. If the trade works, you get it back plus more. If it doesn't, it's gone. And that is okay, because it was already accounted for in your decision to enter. 3. Commit to the plan. Entry, stop, target. All defined, all locked. The market is going to move. You are not going to move your levels in response to that movement. The plan doesn't change mid-trade because the feeling changes. If the stop gets hit, you exit. If the target gets hit, you exit. Between those 2 points, you do not touch the trade. That's it. It sounds simple, but it's not easy. It's a skill, and like every trading skill, it gets more natural with repetition. The first time you sit in a position that moves against you, stay calm because you've already accepted the loss, and then watch it reverse and hit your target. You'll understand what trading from a place of acceptance actually feels like. And it's completely different from anything the emotional version of you has ever experienced at the platform. The market is indifferent. It doesn't know your name, your stop, your strategy, or your story. It is going to do what it does. And what you do in response is the only variable you have any control over. Emotional trading is not a personality flaw. It is a natural response from a brain that was never built for this environment. A brain optimizing for comfort, for certainty, for the fastest path out of discomfort. The market punishes all 3 of those instincts. Consistently, expensively, without exception. The traders who make it aren't the ones who stop feeling. They feel everything. The uncertainty, the urgency, the sting of a loss on a setup they believed in. But they built a system before any of it started. They accepted the risk before they entered. And so when the feeling arrives, it has nowhere to go. The decisions are already made. Trade the probability, accept the risk, let the plan run.